Recessions are rare. Recessions in individual countries or economic communities like the EU do happen with some frequency, but a global recession is different. It's usually the case that even when a large group is in recession, somebody else is expanding. China, in the 70s, 1970s, used to call the U.S. the locomotive. If Germany was in recession, somehow the U.S. could kind of power through, although the U.S. itself had three recessions between 1974 and 1982. But a world recession is rare. We had one around the time of the 2008 financial crisis, even though Australia did power through it okay, and certainly in 2020 during the pandemic lockdowns. But they're unusual, as I say. It's usually one group is in a little bit of trouble, but another group powers through and even can pull the recession country or group out of difficulty. But when global GDP declines, that's rare. We are heading for exactly that. To understand that, let's take a look at some of the largest economic groupings, and I'll start with the United States. Now, the United States had a mild recession in the first half of 2022. If you blinked, you missed it. First quarter GDP was negative, not a lot, about 1.6%. Second quarter GDP was also negative, about 0.9%. So first half as a whole, we had negative GDP. The rule of thumb definition of a recession is 2 consecutive quarters of declining GDP. That's the rule of thumb. We had that. It's in the data. Having said that, it was mild, and third quarter GDP and fourth quarter bounced back. But if there was a recession, it was mild. What I'm talking about is a much more severe recession, much more difficult, much sharper drop in economic output, beginning about now with rising unemployment, slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but market has their own dynamic. They're saying, well, if the Fed raises rates the way I've described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks or buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way. I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, yeah, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned. Because as I say, the Fed's going to over tighten. Now, why doesn't the Fed know this? Well, because they never know, because they have the worst forecasting record of any institution I can think of. Their entire history since 1913 is one blunder after another. And this will just be the latest in a long series. And so just to kind of summarize, the Fed's on a course. We know exactly what it is because they told us. All you have to do is listen to them and believe them. They're going to raise rates, let high rates do its work, do their work, and see the inflation come down, and maybe in 2024 cut rates. What I expect is they are going to raise rates for the next couple of meetings, exactly as I've described, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to finish on a, can't call it a happy note, but global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like your liquidity crisis? No. A recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, a recession or depression and a financial panic converged. So they can happen together, but they don't have to. They can happen individually. What we're in for looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? Well, what people don't understand is that behind the curtain, off balance sheet, this is off balance sheet. You got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with the Q word, 1 quadrillion is 1,000 trillion. So I just said the Fed printed $9 trillion. Maybe it's down to $7 trillion. Yeah. But you have 1,000 trillion of derivatives. And they have to be supported with collateral. Not 100%, not even 10%. I mean, kind of 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this quadrillion-dollar inverted pyramid of derivatives. And right now, what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year Treasury notes as collateral. The only collateral I want are short-term U.S. Treasury bills.